Have you ever stared at a stock chart and just seen a chaotic jumble of lines going up and down? It can feel totally overwhelming. Well, today, we're going to pull back the curtain on one of the most fundamental tools traders use to cut through all that noise. It's called the moving average. And trust me, by the end of this, you'll see exactly how it can help you find real trends in the market.
So let's just start with the most basic question of all. With prices bouncing all over the place, how does a trader actually make that call? How do they decide, okay, this is the moment to buy, or nope, it's time to sell and get out? You might think it's some kind of super secret, complex formula, right? But the truth is the answer starts with a tool that's surprisingly simple. In fact, it's built on a concept you almost definitely learned about way back in school.
To really get a handle on the moving average, we've got to take one step back and just do a quick refresher on the plain old simple average. And you know what? Let's make it fun. We're going to start with a little story that takes place on a beach.
Okay, so picture this. 5 friends are hanging out on the beach, enjoying the sun. At the end of the day, they look around and see 29 empty bottles. Now, we have no idea who drank how many. Maybe one person had 10 and another had 2. All we know is the totals.
So to get a rough idea, you just do some quick math, right? 29 bottles divided by 5 people, and you get 5.8. That's the average. Of course, nobody drank exactly 5.8 bottles, but that number gives us a central point, a quick snapshot of what happened. This very simple idea is the foundation for everything we're about to talk about.
All right, so that was a static one-time average. But in the stock market, things are never static. Prices are changing every single second. So that brings us to the big question. What makes an average move? Well, it's all about keeping up with the latest price action. Let's apply this to a real stock. To get a 5-day average, we just take the closing prices for the last 5 days, add them all up, and divide by 5. That's it. For this period here with Marico Limited, the average comes out to 242.5. Pretty straightforward. Now, watch what happens on the next day of trading. This is the cool part. To keep our average fresh and relevant, we drop the oldest data point, so see you later, July 21st, and we add in the brand new price from July 28th. We do the math again, and our new average is 244.66. It has literally moved. And what we've just created is called a simple moving average, or SMA for short. Because we're constantly updating it, dropping the old, adding the new, the average just keeps moving forward with time. And when you plot all those little average points on a chart and connect the dots, you get that smooth, single line that helps you see the bigger picture.
But hang on, this brings up a really important question. With a simple average, the price from 5 days ago has the exact same influence as the price from yesterday. But in a market that's changing lightning fast, you have to ask yourself, is all that old data really created equal?
And this is where we get a little more sophisticated. You see, the SMA treats every price point the same. It's a total democracy. But then there's the Exponential Moving Average, or EMA. The EMA has a totally different philosophy. It believes that what's happening right now is way more important than what happened last week. It gives more mathematical weight, more oomph to the most recent prices.
And that difference is a huge deal. Because the EMA puts so much emphasis on recent data, it reacts much, much faster to sudden price changes. It's more responsive. And for that very reason, as the source material points out, most active traders prefer to use the EMA. It's just quicker on its feet.
Okay, that's enough theory for now. Let's get practical. How can you actually use one of these lines on a chart to make trading decisions? It's time to put the EMA to work.
So here's a really basic trading system using just one line, the 50-day EMA. The rules could not be simpler. Rule number 1, you get a buy signal when the stock's actual price crosses above that EMA line. And rule number 2, you exit the trade when the price falls back below the line. That's the whole system.
So how did this super simple system do? Well, for Ambuja Cement, it worked beautifully on 2 of the trades, catching a nice 13% gain and then a massive 30% gain. But look at that trade sandwiched in the middle. It only scraped by with a 2.2% return. What gives? Well, the big winning trades happen when the stock was in a strong, clear trend. That middle one? That happened when the stock was just chopping around sideways.
And that right there exposes the system's biggest weakness. It's an incredible tool for following a trend, but when a market isn't going anywhere, when it's just bouncing back and forth, this system can give you tons of false signals, what traders call whipsaws. You get in, you get out, you lose a little, you gain a little. It's frustrating.
So to solve that exact problem, traders came up with a clever upgrade, the moving average crossover system. Its entire purpose is to filter out all that market noise and help you avoid those annoying false signals. Instead of just one EMA, the crossover system puts two of them on the same chart. You'll have a faster one, which is a shorter-term average like a 50-day, and a slower one, which is a longer-term average like a 100-day. The real trading signal comes from how these two lines interact with each other.
Now, the rules are a little different. We don't really care about the stock's price anymore. Instead, you get your buy signal when the faster short-term line crosses above the slower long-term line. This is like a confirmation that upward momentum is building. And your exit signal? You guessed it, it's when that faster line crosses back below the slower one.
And this is why the crossover system is so powerful. It acts as a filter. By forcing you to wait for two different averages to agree, it demands stronger proof that a real, sustainable trend is actually starting. This is what helps traders stay out of those choppy, sideways markets and avoid getting whipsawed to death.
So, after all that, what are the most important things to take away from this? Well, it really all comes down to one of the most famous sayings in all of trading. The trend is your friend.
All right, let's break it down. First, most traders lean towards the EMA because it's just faster to react. Second, and this is crucial, moving averages are trend-following tools. They are your best friend in a trending market and your worst enemy in a sideways one. The crossover system is your upgrade to help filter out the noise in those sideways markets. And finally, a really important pro tip. Using longer time frames, like a 200-day average instead of a 20-day, will give you fewer signals, but the signals you do get are often way more powerful.
And just to give you some concrete examples, here are some popular combinations that traders use all the time. For really short-term, fast trading, a 9 and 21-day EMA pair is pretty common. For medium-term trades that last a few weeks or months, the 25 and 50 is a classic. And for identifying those huge long-term trends for investments, the gold standard is the 100 and 200-day EMA crossover.
In the end, everything we've talked about comes back to this one simple idea. Whether you're using a single line or a crossover system, your goal isn't to predict the future. It's to identify the direction the market is already going and get on board for the ride. Because as every trader eventually learns, you just don't fight the current. The trend is your friend. The only question left is, are you ready to spot the next one?